Good morning, ladies and gentlemen, and thank you again for joining us for Boutiques on Wednesdays, where we continue conversations on equity and SA fixed income. Gold prices, as you all would know by now, reached a new all-time high as central banks continue to diversify away from the US dollar. Returns on the JSE are mainly driven by gold and PGMs, plus counters like Naspers and BATS with a rebound in Chinese equity. Year to date, we've seen similar concentration on global equity returns with a handful of names in big tech companies rebounding. If you were underweight, you are lagging. But gold is very expensive now. Yes, some say it can go to 5,000, who knows? But forward looking, where will returns come from SA equity, and what are those opportunities we should or could be looking at? And then if you look to SA fixed income, how do we stay ahead of the curve, and how should we adjust duration in our fixed income portfolios given the current interest rate cycle? Joining us this morning to unpack SA equity is Charles Ghosh, you're all very familiar with, Director and Fund Manager at Bateleur Capital, and Shwebe Gosha, Portfolio Manager and Analyst at Laurium Capital. Good morning, Charles. Good morning, Shwebe. How are you doing this morning?
Good morning, Eugene. Doing quite well over this side. Thank you.
Fantastic. Lots of green in the market, but like I mentioned, pulled by very specific counters. On the fixed income side, Trevor, we've been spoiled the past 2 years just about, but bond yields are trading slightly lower. So I think clients are still asking, where should they position the fixed income cycle? And more so, I mean, how does Laurium Capital position in the current rate cycle? Trevor, you are first. You can start sharing your slides if you are ready. To our audience, by now you know how it works. Two presenters this morning, two presentations. Afterwards, we'll take a couple of questions. You're more than welcome to post your questions in the Q&A bubble. Trevor, I see you are ready for us. I'm not going to waste any more time. The floor is yours.
Thank you very much, Eugene, for that introduction. And good morning to everyone who's connected online. So today I'll just be spending some time taking you through our presentation, which we've titled How You Move Duration Based on Different Interest Rate Cycles. So the aim here really is just to take you through our thinking and our process and how we've adjusted our fund duration and technically positioned our fund during these times. So I'm just going to skip ahead over here and just kick it off from this slide. So now, before we consider any portfolio adjustment, we must understand that, what are the key drivers of South African bonds? And we have attempted to distill them into 3 R's. And this does form part of our top-down process. So I'll just briefly take you through them. Now, the first R, now we know that South Africa is an open emerging market economy. So our risk-free rate, is not determined in isolation. We are anchored by global yields, especially the US Treasuries. So the direction of travel there, where the US Treasuries land, do tend to have an impact in our own valuation. And then taking us closer to home, on the second R, we spend a lot of time here just scrutinizing and analyzing our domestic cycle. We take into account your growth and where it's going, the trajectory, and thinking about inflation and interest rate cycle, which I will explore a bit further into the presentation. And when we're thinking about South African bonds, really, so when we're valuing bonds, risk premium is another consideration, right? Essentially, this represents the additional yield that us bond investor would actually demand to compensate for holding South African specific risk. So some of the factors that we take into account here, this will be your fiscal dynamics of the sovereign, right? And your credit ratings. Now, it is not a surprise, a couple of years ago, maybe in the early 2000s, South African credit ratings were actually on the higher end of the investment grade spectrum. We know what happened now. It has deteriorated ever since, state capture and other things. And so your fiscal dynamics do play a role in lifting up that country risk premium. So now with this slide, I think using the 3 R's as our base and our foundation, let's shift our focus now to the yield curve dynamics. So what are the key takeaways I would like the audience to take from here is that what's important for us is we must be very intentional in choosing where we invest on the curve and why, because different maturity bonds tend to have different yield drivers. So for instance, in the blue bars, if you're looking at the bonds with 2 to 3 year maturity, they tend to react more to monetary policy actions. So that would be your blue bars over there. So we're quite fortunate, as well as bond investors in SA. We have a highly ranked financial institution, which is the South African Reserve Bank, which is very credible. They communicate, they tell us what they're thinking, they tell us what they're going to do in terms of interest rate. Now, as you venture up the bars, the drivers do change. So monetary policy framework becomes less of a driver for ultra long bonds. If you can see in the SA 30+ year bond, so that quadrant over there, almost over 2/3 of the main drivers will be your fiscal dynamics. So your ultra long bonds with have a maturity profile. I think the longest bond we have on our curve is the 2053 bond, will react more to fiscal dynamics. So how do we internalize this now? So essentially, if we have higher debt to GDP, again, if I look back in the early 2000s, our debt to GDP ratio was around 24%. We're now expected to peak at 77%. So your yield curve will be slightly steeper, especially with those back-end bonds. So now, as an income fund manager, we do believe that if the fiscal dynamics do improve, you may want to venture up the yield curve by adding a bit more duration. So the key thing here is that your sector allocation from this basis becomes very imperative. And this is how our yield curve, the current yield curve would look. So especially the red line. So what I've done here, so in South Africa, we enjoy a very deep liquid market. We currently have 16 bonds across the curve with varying maturities. So on the y-axis, that's your yield to maturity. And then on your x-axis, that's your term to maturity. So I wanted to highlight two different periods that capture different interest rate cycles. So 2022, take 2022, for instance. Now, this was the height of Russia's invasion to Ukraine. We understand what happened there, the disruption to global bond yields. South Africa's headline inflation at the time peaked at 7.8%. We're not there yet. We're not there now. Global bond returns for that year actually were negative at 16%. So this was worse than the global financial crisis. And most of the central banks obviously will need to react to these current dynamics, and they started hiking. Now, our own central bank, we were ahead of the curve. We started hiking in 2021, in November 2021. So our thinking that fosters more into the credibility of our central banks. So the yield curve reflected this volatility. If you look at the back-end bonds, they were closer to 12%. So and pardon me. So it's quite prudent then to protect, against those sharp capital moves. So in terms of fund position, one would tend to, as an income fund, so you tend to focus less on the ultra long bond funds and focus more on the shorter, that gray area, if I may highlight this, the gray area in your yield curve. So 2025 is a stark contrast difference here. So the period looks different. So what has changed? If we compare to the different cycle of interest rates where central banks were cutting, inflation was high all over the world, both in developed markets and both in emerging markets. So 2025 is a different picture. Inflation outlook seems positive. We think that inflation will be well contained, and we're expecting a cycle where interest rates are actually going to be lower locally. So your yield curve will tend to flatten or move lower with the rates. And then as an income fund manager, then you want to slightly increase your holding of duration to the belly of the yield curve over this side. And now where we are, so as Eugene mentioned, so where we are in the cycle right now. So in this chart, this is illustrating, this is our South African headline inflation in the red line and our repo rate in blue. So since 2017, we know that the Reserve Bank has been explicitly targeting the midpoint, which is 4.5. So that's the dotted black line over there. But you will notice that there's a drop-off this year. So in July, the Monetary Policy Committee, expressed a preferred target and explicitly stating that we do have a range in our inflation profile. Lower end is 3%, and the upper bound is is 6%, so they're targeting 4.5% since 2017. And now they pivoted a little bit because inflation did come down. So from the highs of 2022, if you look at the peak, that's 7.8% I was talking about. So inflation has been falling. So they're expressing that they've got an opportune time now to capture this by lowering the target. I mean, since September 2024, the MPC, they have actually reduced rates by 125 basis points. So from this point on, it was 8.25, and we currently know that the repo rate is 7%. So we do believe them when they say, using the 2017 as a playbook to the interest rate cycle, we know that they can achieve this target of 3%. In 2017, it took them roughly about 8 quarters to get to the midpoint of 4.5, and we think that where inflation is trending right now, we could essentially get to the 3% very soon, maybe in the next 2 years or so. I'll just skip on this one. And in terms of the strategic income fund, so this is our duration over time, and you can clearly tell that we're active management strategy over here. Now, the arrow on the right, so this showcases our current nominal duration, and this is where spot level is at 1.4 at the moment. So we do have a duration risk budget that we move and oscillate. So if we're feeling very bullish, we're going to push this arrow slightly higher, and that's exactly what happened in the past couple of months. And if we feel a bit less bullish with the dynamics, global bond yields are selling off, that similar to the beginning of the year. So we tend to put the fund duration a bit low. So I wanted to highlight just key massive moves in the market. So you know that in April we had Liberation Day, Trump tariffs and everything. And then at this point between April and May, we haven't passed our budget. So as the fund manager for an income fund, again, you're quite mindful of what's happening with the dynamics of the market, and also taking into account that, the interest rate cycle is essentially going to cut. So our starting point in April was very low duration, as indicated in the chart, but then we started ratcheting it up, that duration, because we know that, the MPC is going to cut rates. So it does change the dynamics of our market. So we pulled the duration up closer to 6%, and we've enjoyed seriously the rally that Eugene mentioned earlier, and the other factors as well. So it's not just inflation or interest rates. We have lower oil. We have PGMs very outperforming, as Charles will get into it in terms of the gold prices. So all of that caused a massive re-rating in our bonds, and we've enjoyed those capital gains as we held higher duration for the fund. And I just wanted to pick here, this is just your SA 10-year bond yield, just to express how bonds essentially react in different periods. So this re-rating, so the 10-year bond moved from the beginning of May about 150 basis points. So we were trading at 1070 here, and it moved all the way down to 920. So this is essentially having yield in your portfolio, it does matter. And the big last year, the GNU in the mid-June, this is the re-rating of the bonds. Again, we're enjoying yet another swing. So this is just how your bond yields are going to vary and move. And just that I'm quite mindful of the time. So on the last slide here, so we've taken our fund, again, this is a strategic income fund, and plotted against other competitors who are essentially larger than us. And as a low risk fund, we're quite prudent in how we manage duration. We've actually captured the re-rating in bond yields, and this is our risk return profile. So this is our fund versus the rest of the market. And with that, Eugene, I think I'll leave it there.
Baby, thank you so much. Short and sweet and absolutely to the point. Thank you so much for that. Really grateful. You stopped sharing. Charles, you should be able to share.
Thank you, Eugene. Thank you to the rest of the team for the opportunity. And good morning, ladies and gentlemen. So a bit of background on Bateleur Capital. The business was founded in 2004. We launched our first fund, a long-short hedge fund, in 2005. We've got an experienced and stable team that's worked together for many years. We're not a large asset manager by AUM, so we can be nimble and flexible. We can access the broad opportunity set available on the JSE and also internationally in some of the funds and the mandates that allow it. We've got a consistent investment process that we apply across all the funds that we manage. And given our hedge fund background, there's an acute focus on downside protection. And we've been around for 20 years, so we've got lengthy track records that we can display for all the funds that we manage. So let's get into the meat of the presentation. So just to set the scene, what's happened this year, global equities and domestic equities, in our opinion, has continued to climb the wall of worry. There's been lots of external threats, yet we see markets hitting new all-time highs on a daily basis. The dollar has been weak. We've seen strong gains in precious metals as well as precious metal equities. Domestically, GDP growth has been revised lower from, call it a more buoyant expectations at the end of 2024. We've had to deal with GNU instability and the delayed implementation of the reform agenda. Foreigners continue to sell domestic equities. We've seen recent interest in domestic bonds. And in our opinion, the South African Reserve Bank continues to adopt a very restrictive monetary policy. So with that in mind, it's quite interesting that our market is up 29% to the end of September. As we sit here this morning, 33% year to date. And what we've done in this chart is just to highlight to the left of the dotted line, those equities that's outperformed the market, and to the right, those that's underperformed the market. And it's very clear what's driven the returns on the JSE this year. It's all been about precious metals, so PGM and gold mining companies, a select few telecom companies like MTN and Vodacom, and some of the dual listed or rand hedge stocks like Prosus and Naspers has performed well. That long tail to the right is largely reflective of what's happened in South African equities and the underperformance we've seen from the broad base of the market year to date. We've seen continued selling from foreigners. This has been ongoing for a number of years and has continued this year. On the chart, we just show you the year to date foreign selling of some of the prominent SA equities, household names like Shoprite, Absa, Tiger Brands, Discovery, Standard Bank. All these share prices have been under pressure year to date, notwithstanding in many instances credible financial and operational results. We've seen a continued disinvestment from foreigners as well as domestic shareholders selling to rotate into momentum trades like the PGM and the gold sector. This has put pressure on valuation multiples. We can see that pre the formation of the GNU in the middle of last year, a basket of SA focused companies was trading at valuation multiple of approximately a 10 PE. As we expected growth to accelerate domestically, those valuation multiples incorporated higher growth rates into the future and traded up to 13.8 times towards the end of the year, and is now derated back to levels in line with the pre-GNU formation. So in this environment, for us as stock pickers, and specifically for us focused on companies that can compound earnings over time, we again finding great opportunities to deploy capital in the domestic market. And I'll go through 3 examples in the following slides. So the first one I want to touch on is Remgro. Remgro trades at a steep discount of 40% to its net asset value. That means for you as an investor, if you buy Remgro shares to the value of 60 Rand, you get 100 Rands worth of NAV. Now, there's been some very clear drivers of this increase in the discount over the last couple of years. But in short, earnings growth at Remgro has stalled over the last couple of years, and dividends back to Remgro at the center has reduced because they've had a couple of underperforming investees. We expect that to change going forward. We think earnings will inflect higher, and we've seen the first bit of that for the financial year 25, where they reported a 39% increase in earnings. There's a couple of drivers behind that increase, and as well as the expected increase in the years to come. They've completed the Maziv Vodacom transaction, which was a cash flow drain on the business. They've restructured Heineken Distell, a merger that happened a couple of years ago and ran into some initial problems. And thirdly, we expect a better performance from the Mediclinic Switzerland operation, as there's some clear drivers to reduce the cost base. So as earnings compound in the period ahead, we think that will be accompanied by higher dividends back to Remgro, and which will have a positive impact on the discount that Remgro trades at. The second example I want to touch on is Reinet. Reinet currently trades at a 30% discount to its net asset value. Not the highest it's been over time, but there was two very important transactions that happened this year. So firstly, at the start of the year, Reinet sold its stake in British American Tobacco, and towards the middle of the year, they announced that they will be selling their 49% stake in Pension Insurance Corporation. Now, this is important because these two assets make up 80% of Reinet's net asset value. We expect the Pension Corp transaction to be completed early 2026. So we can calculate that at that time, on a pro forma basis, Reinet will hold 5.4 billion euros in net cash, about another 1.2 billion in private equity and fund investments, yet the market cap is 4.6 billion euros. So at the moment, you can acquire Reinet at a 30% discount to net asset value, or 15% discount to its implied cash on the balance sheet. This is great value for us, also a sort of a hedge fund transaction, given our background, where there's, in our opinion, very limited downside, given the high cash holding, and a discount that could create positive surprises. We think there's various corporate action opportunities and possibilities available for Reinet, but most likely Reinet will not exist, in our opinion, in its current form in a year or two. The last example I want to touch on is Standard Bank, and it's a very simple growth at a reasonable price investment that we want to discuss. So Standard Bank has delivered very consistent earnings growth of 10% per year over the last decade, 9% per year from 2018 to 2024, and we expect a similar trend in the years ahead of a growth rate of around 10% per annum. This is driven by the expansion in Africa, where they've done exceptionally well. And with that, it's been a very profitable bank running at close to a 20% ROE. Now for us, this is an ideal type of investment. You acquire Standard Bank at a very attractive valuation of approximately an 8 PE to December 24 and a 7% dividend yield. So from a shareholder point of view, earnings grow 10%, a dividend yield of 7% should result in a return of 17% per annum if the valuation multiple doesn't change. I remind you, at 15% per annum, you double your money every 5 years. So that's a very attractive, low risk opportunity for us. What's also been very interesting year to date is we've seen, and you can see it on the red line there, where we compare the South African 10-year bond yield relative to Standard Bank's earnings yield. The bond yields have moved lower quite dramatically, yet the bank's earnings yields have not reacted. That also gives us a good indication that the timing for banks are favorable at the moment. We've seen a similar scenario in numerous other South African equities where the bond yields have re-rated, yet equity valuations have remained stagnant. This has been the story of the year. GDP growth rates have been revised lower. We entered the year with a lot of optimism, expecting 1.7% GDP growth. That has now decreased to 1%. And to be quite honest, we hope we get to 1% this year. Expectations has now been pushed out to 2025, where for an acceleration of GDP growth. I won't labor this point. It's just SA valuations. SA companies remain attractively priced on both an absolute and a relative basis. And I think this has been the area, the interest rates has been an area where we've been disappointed this year. We would have wanted the Reserve Bank to be a little bit more aggressive, to provide more support to the South African consumer, and in essence, be more aggressive than the 125 basis point reduction we've seen year to date. So the usual question that we get is, South African equities are cheap. So what's going to be the catalyst? as we say there on the top, catalyst unknown. Companies in South Africa on the equity market, in our opinion, remains undervalued and under-owned by both domestic and foreign investors. But when valuations are low and companies are of high quality, you're sure something will happen. We've seen a lot of corporate action year to date. I've listed a couple there. Some are in progress, some are complete. Libstar, Metrofile, Adcock, Ingram, Barloworld, Curo, African Rainbow Capital, MultiChoice, Sasfin Capital, and Regional. All of these are either busy with transactions or have been completed. You can see in the slide here at the bottom what's happened to their share prices over time since they received an offer, so materially higher than where they've traded recently. And I think what's also important is that a number of SA equities currently offer very high dividend yields, consistent dividend yields, in many instances accompanied by special dividends. So you do get paid to wait while you're in SA-focused companies, given the poor sort of sentiment towards South African equities. So where we find ourselves today again is South Africa is again at a low base. It's not priced for any economic activity or recovery. Consumer and business confidence remain fairly uninspiring, and in our opinion, interest rates still present a material opportunity to stimulate the domestic economy. And with all that negativity, I thought I'll end on a positive slide. And we did this exercise at the end of August, and it would have expanded even more over the month of September. But on a 5-year basis, we here compare the JSE All Share Index total return in US dollars versus the MSCI World in US dollars total return in the red line. The JSE has been a good place to invest for the last 5 years, notwithstanding all the headwinds and the negativity that we are so frequently bombarded with. Over the last 5 years, the JSE has compounded at 16% a year versus 13.6% for the MSCI World. If we do the same exercise for 10, 15, and 20 years, the MSCI World has outperformed. Yet over the last 25 years, investors in the South African market has quite comfortably outperformed the world markets in US dollars. So it's not always that bad. And my closing thought is that, ultimately, if you have high quality companies trading at low valuation multiples that's still providing growth, you can generate very good returns. Thank you very much.
Charles, thank you very much for that. And the positioning of your fund, I think top of mind, and I mentioned my opening statement as well, is on everybody's minds of gold and PGMs. And it's exactly that. I mean, if you were underweight those two, anybody that was underweight resources mainly lagged year to date. And it also has the impact on the longer term numbers. I mean, if you pull it through to 2, 3, 4 year numbers, it's got a huge impact. And not to speculate on where gold price is going or not going, but how do you manage it in a SA equity portfolio? I mean, if prices just keep on rallying up, you showed some very good examples, some of the counters that you hold and reasons why you hold them, and huge potential in some of those positions. But what are we as investors, and more specifically as a fund manager? How do you manage PGMs and golds if prices just keep on rallying up?
Yeah, it's so obviously if you look at our particular positioning where we do not carry significant exposure there, in fact we've got no exposure to gold companies at the moment, and very limited exposure to PGMs. It's a big short-term risk that we have to manage. I think ultimately, the way we approach it, and it's always approached is in respect of our investment process, is to build portfolios that can compound over time. And that's why if you look at a Standard Bank example, where we can have comfort that you can potentially double your money in the next 5 years, that's an attractive proposition for us. We don't know where the gold price is going to be. We don't know where the PGM price is going to be in 6 months, never mind in 5 years. So it's always it's a very difficult thing. And when you add that sort of volatility to our market and the size of the precious metal miners in our market, it creates the additional complexity. But for us, it's still about playing the long game and positioning the fund for the longer term. And That has worked for us over our 20-year history, and I'm quite confident it will continue to work for us going forward. So if you look at sort of some of the numbers, precious metals, so if we combine platinum and gold companies, was sort of 10% of the market at the start of the year. It's now 25%. So that in itself give you an idea of just how severe the move has been. So it's a new problem also, because it has not been that big for quite some time. But we actually did an interesting exercise, and what we did with the gold companies is we had a look at their profitability over time. And that coincides with our view that these companies, and specifically the gold companies, not the PGMs, are earning super profits at the moment. So if you go back to sort of the previous two peaks, so 2020 and then 2010 and 2019, 2019 and then the 2010 period. And what we do is we look at the all-in cost of producing an ounce of gold, as well as the current gold price. And both the previous two peaks, and we went back to 1998, that margin that the gold producers were earning was around about $900 to $1,000 per ounce. That's currently $2,200 per ounce. So they have never been as profitable as they are at the moment. And I can be quite confidently say, if you go back in time, both those peaks where they earned those very large margins, the headlines in the newspapers would have been that the gold price is going up further, and it ultimately didn't play out like that. So for us, if we look at gold companies at the moment, where the gold price currently is, we think there's probably a bigger risk of capital loss at the moment than people realize.
Let's just stay with the banks quickly, because I mean, the banks are very attractively priced. You showed the example of Standard Bank, you mentioned it now as well. But in the banking sector, I mean, your top holdings is Standard Bank and FirstRand. But just your views very briefly on Capitec. I know they're trading at a much higher multiple. Is it the multiple the issue, that it's not in the top holdings?
Yeah, I do think it is a multiple issue. And what we've done over time is, when there's a little bit of stress in the market and the sell down, that's usually opportunities for us to top up or acquire a little bit of Capitec. So we've used those sort of periods to dip into Capitec. We think it's a fantastic business. We've got no real concerns operationally and strategically in the business. It's very much a multiple issue. So if we look at Capitec in the low 20s, and you look at a Standard Bank at 8 times and a FirstRand at sort of 10 times forward, that gap is just too wide for us to have materially more exposure to Capitec. But we have topped up every time we've been presented with opportunities where the valuation is a little bit more palatable.
This is another big holding in your portfolio, and we've seen it in some other portfolios as well. Obviously, is Naspers and Prosus. Also worked extremely well year to date with China, on the back of China recovering. We've seen a big rebound in Chinese equities that helped Tencent. Obviously, is a big underlying holding. Going forward, the outlook for Naspers and Prosus, is it still very tied to the hip in terms of the Chinese market recovery?
Yes, most definitely. So it's quite interesting. If you go back 24 months, the headlines were China is uninvestable. This year, you could probably still go back to January this year, and the headlines would have been China's uninvestable and Europe is dead. Yet the Hong Kong Hang Seng Index is one of your best performing indexes this year, and Europe is not far behind. So things do change. In our opinion, Tencent has always been a superbly well-managed business, and they are probably only now entering the period where they can harvest the benefits of artificial intelligence in the products that they have available. So we think there's still quite considerable runway for them to grow earnings at Tencent. But quite rightly, Naspers and Prosus fortunes, as it's been for many, many years, is linked to Tencent. Both companies still trade at quite a healthy discount just to their implied allocation or their implied holding of Tencent. And the new CEO, Fabricio, is very much focusing on unlocking that Tencent plus value for shareholders, where call it for the majority of Naspers' existence, it was Tencent minus calculation for the other initiatives that they've got in place. He's done quite a few acquisitions over the last 6 months, and I think probably set up the business now to start delivering operational results that show improvement. So we do think there's still legs, but always cautious when you've had a very nice run year to date on a particular equity.
Interesting indeed, and lessons learned as well. As you mentioned, you can't always trust headline earnings. You've got to look at the hard facts on the ground. Shwebe, speaking of facts, I mean, Charles also showed the graph on SA's real GDP growth being downgraded continuously. But hand in hand with that, I mean, we know that SA's debt levels are really super unhealthy at the moment. You've showed the chart in terms of where you are on the yield curve. You took advantage of upping duration in portfolios. But I want to play devil's advocate here. Who's to say that SA's yields will not necessarily increase, given our very unhealthy debt levels? And I mean, we know it's very difficult to spend less. There's political challenges behind that. The only way to get out of the situation is to see real growth in SA. Our growth is being adjusted downwards. So the outlook is not very positive. And if it keeps on spiraling out of control and we don't have real growth, we may even see foreigners starting to sell SA bonds again. It's been a huge tailwind the past 18 months. But could we get a scenario where bond yields start to go up again? Is it a no-brainer to have higher duration?
Look, it is a risk, especially now. Again, we've enjoyed this re-rating. So what could be the catalyst for bond yields to the risk of them being elevated? Political climate definitely is one of those. I think what we're looking out for as bond market investors is really we need fixed income investments. We need that kicking off a little bit. We need that infrastructure spend as well from Treasury. So that will be the risk bucket. But on the positive side of why you want to buy duration a bit, some of the catalysts that we're looking out for right now is obviously policy alignment between the SARB and National Treasury, which is the financial minister, just to lock in and officially make a statement about the inflation targeting framework. I think that we could see a potential re-rating of rates lower. We know that the SARB is not done. They pause right now. Yes, repo rate is 7%, but their forecast in the next 2 years is actually for a terminal rate of 6%, which I think will aid in the banking sector and the listing. So on the risk, we're quite mindful of what's happening there, but growth in SA is very anemic, but we do need those investments to coming in. And foreigners have actually been loving our markets. Like year to date, we have 163 billion of inflows from foreigners. So again, I think this speaks to the EM carry trade and the pivot from US to more searching for yield. So we have benefited from that. But we're quite mindful that if we don't get the structural reforms up and going, they're in a snail pace kind of movement at the moment, but we need that revitalization. Then we can get a better growth of hopefully above 1%.
And to all of that, I mean, it remains an actively managed fund, so you will move on the yield curve as scenarios change. So it's not a case of what if or when. We know that you actively manage that. I want to step away from SA bonds and just look very quickly at things like credit, SA credit, especially the banks. A lot of the banks trading below SA bond yields at the moment. So it's almost like corporate credit. Spreads are too thin. If you're not in SA govies or bonds, where is the rest of your portfolio?
So we aim to diversify. One of our building blocks is obviously credit cash enhancing strategies. So that's your credit market. And yes, credit spreads are very depressed at the moment. And we've diversified by having other credits such as your additional tier 1 paper that is proven actually to be better yielding in the secondary market especially, and inflation-linked bonds. So this is part of our building blocks. So we have a bit of property there, we have a bit of inflation-linked bonds for that inflation protection. We don't have to have it, but given that, you know, inflation has been ratcheting up for the past 2 years, so it's quite prudent for a fund like a strategic income fund to have some linkers and a bit of property as well. I think that has helped, especially when it behaves like a bond. Your growth point will be the counters, very defensive, that will add into our portfolio. So we do try to diversify as much as possible. We won't have all our eggs in one basket in SHEBs because we're not a pure bond fund, but definitely on the credit side, we tend to venture off a little bit just to hunt for yield, especially in the secondary market.
You actually opened the door to my next question, and that was on SA property, because we haven't seen SA property and fixed income funds for the past 6 years, and I think we'll understand why, exactly why. But SA property performed extremely well over the past 18 months, a strong rebound. And some may say, but you know, it was just a rebound from extremely depressed levels. And I know that income funds can take up to, correct me if I'm wrong, 10% SA property. Are we in that place again where we're going to see property becoming a bigger feature in income funds going forward?
I think if I look at my peers, I mean, I think we all have an exposure to property. But again, here, if property is acting like a bond, you know, it's quite defensive counters. And given where we are in the interest rate cycle, I mean, this is one of the trades that actually worked for our income fund, is to add in property. And again, we have to be very choosy on which counters that we go for. So yeah, I think the outlook for property for now, it's a hold. We won't increase it up. I think we have about 4% in our fund, diversified across 2 counters. So given the interest rate cycle, where those yields are going, I think it has definitely worked for us.
Charles, from an equity perspective, your views on SA property is something that you're including at the moment?
No, we don't have any property holdings at the moment. I think what's quite interesting, and maybe that's a longer sort of topic to discuss, is we're getting divergent sort of views from the market. So if you look at the equity valuations, that hasn't moved, pretty much contracted year to date. You've seen a step up in property valuations, and you've seen a decline in the bond yields. So the question that we sort of really grappling with is, you know, what message is that you're getting from the market, and a lot of that happened after the announcement of the 3% targeting of the inflation rate. So, you know, either the bond market and the property market, which is strange because they will also be impacted, is telling you that economic growth won't pick up because conditions will remain constrained, because rates will stay high to get to the 3% inflation target, or the bonds are expensive. You know, that's the other thing that the market's then potentially telling you. So yeah, we're getting those sort of conflicting signs, and we would rather err on the side of the lower valuations in the equities.
Interesting indeed. Charles, I'm going to look at one of the questions from the audience and asking for comments on Barlow shares and, you know, the impact of Saudi Arabia on a buyout of 120 Rand per share.
Yeah, I mean, that transaction, as far as I know, pretty much done. We're not involved in Barloworld, so I think the last numbers I saw, that's been sort of a acceptance rate in the high 80% already. So that will probably result in Bateleur being delisted within the next couple of months. I'm not quite sure on the Saudi Arabia question or angle that I must explain.
Connection, yeah. Yeah. 100% fine. I think we covered all bases. Charles and Shwebe, thank you so much for joining us this morning. It's been really great to have you with us as always. A lot of insight there in terms of where we are, active management portfolios, and you know, it's not a no-brainer to only have high duration. You need an actively managed fund, and it's also not a no-brainer just to go and buy gold. There's other real great opportunities in SA with very, very attractive valuations. Thank you so much for joining us this morning, and to our audience as well. Looking forward and seeing you all again on next week, Wednesday, for Boutiques on Wednesdays. Charles, Shwebi, thank you again for your time this morning. We're always grateful.